So let me show you what I did last night. I'm trying to prep a little bit more because we are in a confusing time with the markets not really giving us what we need with the labor strike and all these other things. But let's dive right into this. Where we at? So I ran the echoes on yesterday's analysis. Right today, we're doing the unemployment rate and the non-farm payroll. And I really wanted to know if that thing was going to, give us anything because I kind of want to go into our new inverted model, which we may run a little bit later. But the first thing I want to do is kind of confirm what is this labor report is going to be. So I'll walk you through this. I I ran the echo model. Give me a second. I want to make sure everything is shared. All right, so I let me see if I can find it. Yeah, so it starts right here, December 15th. Well, that's when I ran it. Uh, head of macro sentiment alert, December 16th, labor data, high alert. The data void created by the October shutdown ends tomorrow. Think about that. This is a good thing. The data void created by October shutdown ends tomorrow. So this is the last of those reports that are coming back online. All right, we are flying into a volatile storm. So I think this is the last one. It said it ends tomorrow. So any economic report that comes out after tomorrow is back on schedule, which is a good thing. So once again, that gives us 2 more weeks in 2025 to kind of see if we can get back on track. All right, the Federal Reserve cut rates by 25 basis point last week as insurance, but tomorrow's data, a double feature, releasing delayed October numbers alongside finalized November figures will judge that decision. All right, reviewing the trend leading up to tomorrow's 12/16 release, the momentum is undeniably decelerating. The soft landing narrative is rapidly eroding into a growth scare. Trend direction, bearish for labor, and that was the key. Bearish for labor, bullish for bonds. Once again, we don't trade bonds, right? But we can use the bullish for bonds. And this is what I mean about having this data. Because if I was to lay that inverted model on top of here, it would go through here between labor being bullish and bonds being bullish. I'm sorry, between labor being bearish and bonds being bullish. I can run that inverted model, and we can get an idea of what other markets are available. Which, like I said, we may run that a little bit later, just to kind of test it out to see how it works. Well, let's finish off with the labor analysis. It says the rate of change is hiring in hiring has collapsed. We moved from 144,000 average in Q2 to 45,000 average in Q4. August 2025 was the crack. And then here's where we always kind of pay attention. When non-farm payroll barely hit 22, the SOM rule chatter spiked. I did not know what the SOM rule was. I right clicked on it, I hit search, and sure enough, it's a recession indicator. It's a real time indicator created by economist Claudius Sohm to signal the start of a US recession. But notice it's not saying that it's a recession, it's saying that the chatter about recession, which we know that's not true. We know this is a scare tactic. Anything where they bring in a recession immediately, when they know that it takes up to 3 to 6 months, If they initially starts bringing up a recession, it's all a fear tactic. And we should see that clearly at this point. So they say the Sun rule chatter spiked. September's 119 print is now viewed as a dead cat bounce. I had to look this up. So this is very telling. So here's what a dead cat bounce is. I did not know. I did not know that that's what this setup was called. When the market falls 50 over 50%, it does a nice little kind of recover and then it falls again. Did anybody else know this? Dead cat bounce.
No, that's the first time I heard that one.
No, that's in them other rooms.
And this is something that I learned, and I mentioned this probably last year, is that I was watching a YouTube video on two different traders. I think both of them were option traders, but one person was trying to explain options in a way, like I said, it was on a podcast, I believe. And the way that the one person explained the options, the other person said, I never heard that before. And I kind of used that as an example because you can be trading for years. I'm talking like even decades. And two people will have two different ways of explaining how the stock market works, two different forms of terminology. And you can go years without understanding or even hearing the reference of those kind of ways of explaining it. So I thought it was very interesting that I had said that, like, people will come into my live and they'll make certain statements. And what do I always say? You got to explain that further. Like, I don't know what that term is. Now, I'm not going to tell them that I don't understand what the term, because people are already looking to disqualify me. Or if you don't know what that means, and I know it goes deep in that, you can go years and decades and somebody can explain the stock market or terminology completely different than what you do because you learned it a different way. So I'm using that the same as this, that if you hear terminology, do not worry about it. Everybody has different terminology. People will create a different term and it just never catches on in your world the way that you learn it. So I never heard of the dead cat bounce. Like I said, I'm not really a chartist, so that might be a reason why. I don't really trade setups, which I told you guys is just false and what's the word for it? It's confirmation bias. It's just you see what you want to see. Remember I explained this when you're looking at charts, you see what you want to see. And so that's the reason why I don't trade patterns. A lot of people put their stake in, they want to see a pattern. But I showed you a video multiple times of Warren Buffett showing you those illusions. And that's basically what he equated with charting. You see what you want to see. So, like I said, I don't trade the setups, so which means I never heard of a dead cat bounce. And I'll be honest with you, I'm not going to remember that terminology because I don't trade setups. But we do understand what it is. It's a temporary short-term price recovery in a stock market that's in a strong, prolonged decline based on the saying that even a dead cat will bounce if it falls from a great height. It's a sucker rally. It's a sucker's rally or rely rally or relief rally that tricks investors into thinking a turnaround is happening only for the downtrend to resume, often to new lows. So how does this apply? It says it's now viewed as a dead cat bounce or a seasonal adjustment error, not a recovery. All right, rate of change in news and communication. We track the volatility and valence. I've never heard of valence. The heck is valence? The combining power of an element related to or denoting electrons. Nope, the number. Yeah. So the combining power of an element, especially as measured by the number of hydrogen, that's not even a correct term. Yeah, I don't know what that means. That doesn't even match up. All right, so we track the volatility of media keywords. I'm sorry, the velocity of media keywords. Recession mentions plus 40%. Stagflation mentions 150%. So once again, these are methods of fear that they're going to put into the news. And it's instantaneous, guys. If anything bad happens, these are the first words that you're going to see increase. And you're showing you a 40% increase in the word recession, 150% increase in stagflation. But it's just tactics. So to create fear and uncertainty in the markets. And we know better at this point. But I like how the Echo model is finding it. That's the whole purpose of the Echo. Find me the things in the news that are not true, that's causing people to react. That's trying to identify the signal from the noise. All right, TV media moved from cautious optimism in October to defensive posturing in December. CNBC anchors are openly debating debating when, not if, the 10-year yield breaks 3.5. Corporate guidance, Q4 earnings calls have seen a massive spike in phrases like headcount management, attrition, and automation efficiency, replacing workers with AI. That's the word, automation efficiency.
Headcount management.
Yep, I'm seeing it all.
That is cool.
And that's for
there's going to be a whole new. There's going to be a whole new term just for what we're in, because this is like a recession of the mind, but not the recession of physical world.
Yep. Well, yeah, these are two new terms: head count management. And keep in mind, and there's two ways that I'm going to look this up later. But is it talking about counting the heads of management, or is it talking about management counting heads? Because this can be taken two different ways. Because and the reason why I say it is that even management may be affected by it. Even executives may be affected by it. Does this make sense?
Yeah, because it says that the strategic process of planning, tracking, and optimizing an organization's workforce size and composition to meet business goals without budget.
Yep. So this headcount management can go both ways, where they're not just counting regular workers, they're counting management, executives, all the way up to even the board of directors.
It also says ensuring the right people with the right skills are in the right role at the right time for both current and future needs involving HR, finance, and leadership and forecasting, hiring, and managing employee numbers. Yeah, no more square pegs and square holes. They're going to be going octagons and all kinds of weird shapes.
I totally agree. And then the automation efficiency is the new term for replacing workers with AI. Automation efficiency. We got to remember this one. All right, so let's get into the echoes. The double barrel labor report, which is once again the unemployment rate and the non-farm payroll. Why it matters. It says the market has been pricing assets based on vibes. So this lets you know right now the markets are pricing vibes, not actual data. And alternative data for 6 weeks. This releases the pressure valve. It validates or invalidates the Fed's December 10 cut. Now pause. Right there, I had to figure out what that meant. So I went to Grok, and here's what I put into Grok. I said, how did the Fed's December 10 rate cut validate the previous labor metrics? All right, so you're telling me that this is going to it's going to validate or invalidate the decision that the Fed made about cutting the rate. So I want to know what that means. So how does the Fed decision, how is that going to validate the labor metrics? So it says the Federal Reserve concluded on December and cut federal basis 25 points. This marked the third consecutive. The decision directly responded to signs of softening labor markets, which recent metrics have highlighted as a growing concern. Recent data showed slowing job gains throughout the year. An unemployment rate edged up to 4.4% in September. low hiring and layoff rates, declining job openings, a quits rate falling to its lowest since early 2021. Private sector indicators and alternative data sources further points to weaknesses, such as reduced private sector jobs, additions to November, and broader cooling. Now, here's where I like it's given the federal rationale on why they did it. It's given the forward guidance, well positioned. And here's a second question: will the double barrel? I took that term from the other report, the ECHO report, the double barrel labor report tomorrow at 8:30. Will it provide a catalyst for a bullish momentum in the markets if it validates the federal announcement? So what this means is, what I'm asking is, because I want to know, is saying that it's going to validate or invalidate. And what I was looking for is that is the markets, let's go back and look at it again. My question was releasing that pressure, and then it's going to validate the Fed. So the question that I had was, are the market participants, are they no longer focusing on the actual labor? Or are they going to, is the market going to move based on the validation? Because we've seen this in the past, where we even saw it with the Fed, where they're not focusing on how that Fed metrics are going to affect the real-time economy. No, sometimes they switch gears and they want to focus on their expectation. So that's what I was trying to figure out. Okay, are they abandoning the actual data, and now are they just looking to see if it's going to validate the Fed's announcement, and maybe that will spark the markets to move up? I needed to figure it out. So that's what this second thing is. Is it going to create a catalyst? This double barrel, is it going to create a catalyst for a bull momentum if it validates the Fed announcement? Let me show you what it gave me, and I'm just going to scroll down to it. It says markets will primarily react to the labor metrics themselves. And that's what I put in. Or will it only react to the labor metrics themselves? It's going to react to the labor metric itself. So no, it is not going to abandon the metrics and then follow, the validation of the Fed. And I needed to know that out. So here's what that means. There is no labor. Labor is not going to go up, because we already saw that labor is going to be bearish. So I was just double checking to see if even though labor is bearish, can we still get a bull rally out of the potential of the validation? And it said nope. Does everybody get this?
Yeah, it kind of goes back to when we was talking a couple of days ago about the AI production, AI influenced labor. That's what it sounds like, AI influenced labor. Because if we're still producing and there aren't any head counts like the metrics of old, then we're actually in that era, or we're actually witnessing metrics of this magnitude changing when it comes to labor. Because you're producing, but you don't need human bodies to do it, but you're still producing. And so if our metrics is what production indicator this and that, and yeah, that, I see why they shut down the government in October.
Well, here's something that I always say when things like that happen. They're putting in a new system. We got construction going on, guys. Take a couple weeks off. That's how I look at it sometimes. Like shutting down TikTok and then opening it back up 24 hours later. You're putting in new infrastructure. So that's how I viewed it. What are y'all changing? We got some construction going on, guys, in the front lobby. Take a week off. They changed something. And we're kind of seeing what that is. Because I already told you, like, shutting down that much, and I'll tell you why I say it. And I've saying this for 3 years. The biggest fear, especially for the Fed, but the biggest fear is a run on the bank. You want to talk about a run on the bank? We're talking about, I could probably pick a dozen different market crashes. We can go through history and we can see that a run on the bank created like the majority of the market crashes. And that is the biggest fear of the government and the Fed. And I even tell you that sometimes the economy is vulnerable, fragile. So a government shutdown when the economy and the markets are already doing bad, it can spark a run on the bank. And I'll even give you another example. I talked about that largest crypto theft in January. If that thing was widespread, if they let that out on the media, there would have been a run on the bank. The same way there was 2 years ago when we had the banking collapse, the crypto banking collapse. Now they got that under wraps, but I told you at that time when we were going through it, and I even told you I can remember that even when we were going through that banking crisis in the early of the year, I even told you that when we were going over the economic reports, they were releasing them. They were completely releasing them because they didn't want people running on the bank because of the data. So they were leaking. They were literally leaking the economic reports. So that's what kind of sparked my curiosity about the government shutdown, especially being so long. That the markets and the economy were already, the T virus and all these other things. We had early in that year, we went through a recession. We almost touched in a crash because one of the markets went into a crash. Well, at least for the numbers, I think the S&P 500 went into a crash numbers. So just coming off of that, it's already fragile. And then to do a government shutdown, it's normally not done. So there has to have been some other reason of why they would have done it. Outside of the Congress shorting the markets. Let's go ahead and put that out there as well. They were putting in that, that's something else that I said. They were putting in their positions. They shorted the market through the shutdown, and they repositioned for any of these Mag 7 or different AI companies. So they all traded the stock market for 45 days and probably made millions. All right, but it's good to know that the labor is not going to perform. So we don't even have to go any further. So now I want to kind of get into, well, what do we do now? So my thinking is, let's see if we can figure out an inverted market. And I'm trying, and I always think immediately prime correlation. I would have to go with. I want to see what market I want to use. I'm sorry, what AI I want to use. We got to start with dollar and oil. All right, and even in the model, the original prompt, I even said everything's based on oil. So that's probably where we should start, is the oil. And then we can find the correlation between the oil and the index futures. And then we know the index future is going to go down. But we want to confirm, because I keep telling you those are not directly tied together. So we got to figure out where oil is first. And we got to make sure that oil is not going to affect that negative correlation with the index futures. So let's go ahead and look up oil first. And this is all on the fly. Now, what I did was, I would love to know what happened after market at 6 o'clock. Did everybody see that? What the heck happened at 6 o'clock after market?
Look like a media struck.
That's crazy right there. And let me look at the range on it. 48, 480, 470, 48, 470, all the way up to 48, 830. So that's about 60 points, 60, 70 points. Straight up.
Backdooring.
So the first thing I looked up when I saw that, I went back to my model because remember we have our schedule, and I was trying to see was it another market coming in, but nope. Australia and Tokyo don't start till 7. Is that their pre-market? Maybe that's Australia and Japan's pre-market at 6 o'clock, or is that US aftermarket? Either way, I don't know the catalyst for it. And maybe through some research today, we can kind of try to figure out what the heck happened. What kind of news dropped at 6 o'clock after market?
Their manipulation is look like a slap on the hand compared to ours. It's like, okay, we'll help you guys. I mean, look at that ride up, man. I mean,
Yep.
they did not stop. It's like they all held hands and just saying kumbaya, and it went straight up. Wouldn't this be impactful by markets that have weight like US, China, and India?
Yep. Now, here's something else. Unless it was something specific at that time, maybe some kind of news dropped. It's like they did it on purpose because that price action should have been in the actual markets. But it's like they held off. Remember I say they trade off market? This is one of those kind of things where you guys could have bought it. If you were buying millions of dollars of something, you could have bought it at the close. You could have marked the close, but you didn't want it in the markets. You waited to after the markets and then you bought whatever you bought.
Could they have gotten early information on the jobs report?
I don't know. That's what I'm trying to say. I don't know what it was. But they purposely chose to wait to after the markets closed to buy that big, huge jump. And that's multiple institutions. That's institutional movement. So this is Australia and Japan coming in at 20. Even though 19 is where their market opens, but it fell hard. But yeah, man, I'm curious about this. But we'll come back to it. I'll try to figure it out. Let's go ahead and look up the oil. So oil is down. Guess I could look up Brent as well. Oh, don't do that. Oh, no, 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 no. All right, so both the oils are down. And this is what I want to look up first to make sure. And if you guys are going to be using this inverted model, this is the first thing you should do. Before you ever use the inverted model, see where the oil and the dollar is. Does this make sense?
Yes, sir.
Yeah,
Mark?
we'd have to.
Yes, it makes sense.
Yeah. Go ahead, Roy.
No, I was just saying we'd have to actually also keep up with our analysis globally since we're now being forced into this King Cheetah stage of geopolitics because there's a lot of chatter back and forth. There's a lot more rocks that we got to deal with than we have to over here. A lot of
Yeah.
small rocks. And this back and forth with oil consumption, especially with OPEC, because these guys know it. Ours is not going to say anything, but OPEC will. Sometimes they'll leak it out. But this fact that they're going back and forth, that world consumption for oil is slowed because of EV. And then just recently, I think it was yesterday, where that knucklehead of Ford, as a funny looking guy, the CEO, he comes out and says they're shutting down their entire EV production, which has been an abysmal uh, joke. I mean, that EV truck and all that stuff, they've lost billions on that. So they're shutting it completely down. But they still have shops in China like Tesla. So I can't see how that helps to try to mask the fact that the world consumption oil is reducing, when in actuality it's increasing, especially when you consider data and just domestic growth nation by nation. I can't. It's impossible to do without oil.
Yeah. And then here we have the oil and the dollar, which are also going together. So like I said, I would look up prime correlation, but notice I looked up both oils and I looked up dollar and oil. This should be where you start. We have not abandoned our original kind of concept of always start with the prime correlation. And then if we see this, and I kind of want to show, let me look at a 5 days so we get a real. So yeah, it's been a major decline over several days, like a week. So I don't want to just look at one day. I want to see the actual trend. And this is a trend. Markets have come down on both of these. And we had that, all of this came down after the Fed report, because the Fed was on the 10th, right? This was on the 10th. You see the oil increasing? This was the 10th. And then after that Fed report, everything started falling.
Yeah.
And I'll tell you this much as well. The inversion changed because the oil went up and the dollar came down. You see the inverted here? Completely inverted. And then after this inverted was over, then the dollar switched. But both of them have been in a decline for the last week after the Fed announcement. So now let's go and see if we can put something together. Let's see, I don't know which AI platform to use. I think I'm going to use the Claude because it's kind of hard to copy out a lot of this stuff in Gemini. Now I am going to use the Gemini prompt, but let me build this real quick. So first thing I want to do, I did tell you that we're going to I guess download as a PDF. Well, no, let me go back up and get the actual matrix. This is our correlation matrix. So I'm going to download this first as a PDF. Inverted. No, I'm just going to put correlation matrix. And we will put this. I don't really know where to put it, so we'll just leave it in the main folder. But then I also want the prompts, and Gemini has a really good prompt. Let's see if I can get that. The correlation engine. Yeah, so I'm going to copy this prompt out. Save as. Well, I guess that is the prompt, isn't it? Can you put that back in? So this is the correlation prompt. All right, let's see what we can do with that. I think I'm gonna do a new. Well, no, we. All right, I'll leave it up to you guys. Should we do Claude or Gemini?
I was gonna say Gemini.
Gemini has really shown itself to kind of. Now, did you guys? I don't know if I posted the video, but do you guys remember back? Just pause for a second, because it reminds me of a video that I saw. Remember, I was complaining about Google when we were going through all of that Mag 7 analysis the beginning of last year. We went through every single Mag 7 and we got to Google, and I was so disappointed. And I'm like, Google was the beginning of all of this. How did they just let all this happen? How did they let AI take over? Well, I just saw a video this last weekend where they said that Google had AI first. They were afraid to release it. Let that sink in. Google had a version.
I saw a video like that where they had that version. So you called it 2 years ago, and you called them out on it. They just sitting on the sidelines and they're not doing, because that's when a lot of them was starting to actually activate their AIs, and the browser, the old school browser with just the blue highlights. Those days were gone, and it was becoming more of an ad. It just hadn't hit Google yet. You know what I mean? It hadn't hit the browser yet. And you was like, what the hell are they doing? And so that makes sense. I think I seen that, but my fat fingers got in the way in trying to forward it over to WhatsApp. But I've seen little hints of it.
Because that's exactly what I said when I did the analysis. I says all of these Mag 7 are sitting in a vault of when they buy a company out. They're sitting with a vault of technology that just sits there until it's time to use it. And I said, I know Google has to have, a lot of things in their vault that they could have come out with over these years. Now, let me tell you why they probably didn't, why they were scared to. Because what happened when AI came out? It made the search obsolete. They knew that once they released it, that the competition was going to take over and they were going to make Google search obsolete. So releasing it would have not put them ahead. It would have actually put them behind. And they were fearful of how that would have turned out in the markets. But the reason why I'm giving you that now is we see now why the Gemini has come over, because they started off with, they already had the technology. So it's not like Google is coming in fresh. Google already had AI or a version of it. So it was a lot easier for them to come in, especially with all of these other, and then basically the same thing I'm saying is that once all these other AIs come out, they can take that stuff and then add it to their existing framework. And now Gemini is now taking over ChatGPT. But I thought that was interesting. All right, so let's use. Go ahead.
They're just like Tesla. It seems like these bigger ones, what they do is they sit back and they know that they've got a lot of chips. I know I got more weight, so I'm gonna let the smaller guys play their hands out, and then I'm gonna put my hand down. Then I'm gonna, throw my cards out, absorb whatever strategy they have, and add it to mine. And then, because they already know it, Tesla does the same thing with its robots. They let all these humanoid robots and all these new add-on features come out. And then they'll show just one little feature of it running more human-like, and it killed all of the research and all of the new development and all the new brand new features that they were coming out with just that one display. So it seems like they all just sit back and let the little ones just, like OpenAI is scared, right? Is it Chat? Yeah, is it OpenAI? What's that, Sam?
Yeah, ChatGPT. Yeah,
ChatGPT, reason why he's doing a red flag or saying, hey, we need to get our game up, from what I'm hearing, is because China is doing an open source. And that
was what I was going to bring up, because what you're saying about Tesla and other companies. That's what China's doing to everybody. China's letting all these little tech companies come out with
Right.
their version, and China just sitting back like, aha. Yeah, they're taking on top. Like we already have that. We've had that for a while. And a lot of the stuff that they do have, they don't even release because
The big
and now that
Mhm.
really sets the tone with thinking about Gemini or thinking about Google on why they didn't release it because it wouldn't have benefit them. So there's probably technology that China's sitting on that if they release it, it's going to backfire on them because competition is going to take over and then create competition, which they don't want. So they rather just hold on to it until it's time to release. So yeah, I totally agree with what you're saying.
Do you think it's more of an open source and closed source? Because we have a closed source for all of our system. China's battling us with an open source. So
But they're
do
doing
you think that everything we doing is like they're trying to make an exclusivity golfers club, and here they come with this Rodney Dangerfield theme, and it just draws everybody in. You know what I'm saying?
yeah,
He's
but I'm
got yeah, that's what because they've got every time they come out and they say, okay, well, this is exclusive. And mind you, we're just not talking about general AI. We've been in general AI, but now they're trying to really exclusively call it AI. And then they're saying we got super AI. And then when they gave those chips over to NVIDIA, I mean to China, and China was like, nah, bro, that's okay. You can keep them. You can
yeah, we
keep them.
yeah, we passed that. Yeah.
Yeah, we that ship sailed. So ever since then, they're like, okay, well, you do what you're gonna do. We're gonna open source. It's gonna be free. They're making everything a free library, and we want to make it some type of exclusive Harvard, type of,
Well,
underground type stuff.
I'm gonna give you two ideas on this. Number one, I always go back to the Amazon model because Amazon to this day they were able to kind of open up their margins, but to this day Amazon is still making all of their money off of margins, and what that means is they don't make the same amount of money. They would rather keep their pricing tight because they buy in bulk, and by keeping their pricing tight, they suffocate all of their competition. Right? They can't compete. Toys R Us went belly up. Sears, Macy's, even the whole mall at this point, you can blame it on Amazon. Amazon kept their pricing so tight that they basically ended real time retail. So I always go back to that because Amazon went literally a decade before they made a real profit because they just kept their margins tight and they just kept making a little bit of money off of the bulk, people buying so much that they were able to make money. And then, like I said, they suffocated and choked out the competition. I think that's why China is doing open source. All right, they're basically saying, well, you're charging, all of these fees. Well, we're gonna choke out the competition because we're gonna release a free version at the same quality. Why should I pay for this when I can get this version for free? The second thing, which I've also mentioned this, is that the US model is based on the Uber model, where we can go and keep in mind, it's not the same as the Amazon model because Amazon went a decade without making a profit for that particular reason, where they were squeezing out, they were keeping their margins tight. Uber didn't do the same thing. Uber went a whole decade not making a profit because they did not want to pay taxes or whatever reason. And then that's what you see right now in the US. People want the like I said, you can go to Google headquarters and they got matcha tea and they got recliners. They got, like I said, they spend so much money where they can just write it off. And what's another example? Movies. There's no way that it costs $400 million to make a movie, but they're doing buffet on every day on set. So this is just how the US model works, that they're going to raise all this money and then they're going to just spend it frivolously and then use it as a means of why they didn't make it a profit. But because here's the thing, guys, the reason why that model works for the US is because the investors are still getting paid. I promise you, because that's the other thing, that even though they're not making a profit, new investors are coming on board. Look at ChatGPT. This man says, we don't know how we're going to make our money. and investors are still coming in spending money. They would not come in if they were not getting an ROI. So
It's
we
the
know.
institutions that have FOMO, not us.
So that's just the model that the investors are getting their money in that time period. You don't think Uber was paying their investors that entire decade of we're not making a profit? Of course they were. They were expanding worldwide. And here's the key. They were investing billions into driverless technology. That is where they were putting the majority of their money where they can claim a loss. R&D. So that's the second thing about the US model. They're going to raise all this money so everybody can be a billionaire. And then China comes in right on top and say, we don't do that model. We can do it for $1 million. You're doing it for $1 billion, we can do it for $1 million. So that's the second reason why China is doing the open source. But I like the way that Google is representing. It now makes sense why Gemini is coming back on top of ChatGPT. Well, let's build this. This is the prompts. Let's go ahead and bring in that correlation matrix. Your goal is to use the attached correlation matrix to identify high probability, low risk, bullish momentum trades. Perfect. So then we go through all of this. Try to see if there's anything else. Let me think about this, guys. Should I put in the prime correlation? No, because I do want to show. I do want to give the prime correlation priority. So let me do that as well. Base correlation. Oil versus dollar. This is the prime correlation that all other correlations are based on. Consider this relationship first and span out to other markets and commodities. Expand out to other markets and commodities. So we got our oil versus dollar in. And I want to do a final assessment. Final assessment. Lead all correlations back to the index futures, starting with the Dow Jones. Then consider inverted markets from for the index futures to create alternative trading opportunities. Now, obviously, this is my first time running this. I'm not saying this is going to be the best prompt, but we can, because this is the first time running it. It's always going to be a test, but we can update the prompt, even taking it to the 4D, all of that. But let's just run this real quick. I got the prime correlation, base correlation, and I got the final understanding of the final assessment. Lead it to the index futures and then invert it and give us another market that we can trade. So let's go ahead and run this. I like it. I like it. I like it. All right. I will utilize the inverted relationships between oil, dollar, bonds, and gold to generate high probability long only ETF trade setups when the broad market outlook is bearish or uncertain. See, that's not the only thing I wanted. I wanted I want the dollar index included in that. I want the gold market included in that. But notice how it says only long ETF trades. So I got to update that part because I want to include other future indexes. But let's run this right now and see. All right, as per your instructions, I will prioritize oil versus dollar relationship as the base correlation and ensure all analysis leads back to the implications for index futures, specifically the Dow Jones Industrial Average, which has unique sensitivities to energy and industrial inputs. To activate the engine and run the analysis, please provide the following 2 data points: the upcoming economic events. And I probably should have ran this on the labor, shouldn't I? Should I go back and run this on the labor, guys?
No, that'll be too much because you'll have you're trying to get the metrics for the inversion. You'll be leading it into trying to get like analysis for employment. This is what I would think.
Well, I'm with you, but let's do this. And I'm agreeing with you. I'm agreeing with you. And I apologize for cutting you off because the thought just came to my head. I can run the labor analysis now. So now the framework is the inversion by running that first. Does this make sense?
Yeah, within Gemini to kind of lead it towards a conversation, or are you going to get another agent?
Well, no, because it's asking me for the upcoming data, so I can now go back and put in the employee acronym. I can put in the trends. I don't have to run the not if I don't want to. I can pick and choose. Anything in our regular process. So I can run the employee, I can run the trends, and I can run the rhetorical. Because we need
do you think the forward should be there? Do you think the forward should be anywhere in there?
The forward? What the heck? I'm missing it.
Forge before the rhetorical. Forge, don't you have a forge?
The forge, but we're doing labor.
I was thinking about production though as well.
No, because think about it. The labor reports is coming out. Well, it just came out. We just missed it at 8:30. But I was trying to get in for the labor.
You're right. Because we got to play catch up data with that missed data in October. Yeah. I'm sorry. Go ahead.
So when the labor is not giving us a bullish sentiment, I got to replace the labor. So when the labor announcement comes out, I want to know what the inverted is. But we're already at 8:30. But let's still run it to see.
I see what you're getting at. You might as well get all the little pieces, little hairs in it instead of having to go back and do it again.
Yeah, the moment that we realize that a trade is not going to give us the strong momentum, we want to immediately convert over to the inverted. And then now, like I said, you can either add the inverted on to the existing analysis, but I kind of like this better because you're creating the inverted framework first, and then you can run the economic metrics. Which one do you guys think is better? Lay the correlation on top, or start with the correlation and use that as the base framework? No
The base
thoughts?
sounds like you can go in so many other directions.
Yeah, yeah, obviously. But I like what you were talking about is that you don't want to confuse because we know about AI. We don't want to confuse it. We give it too many tasks. So, but if I'm coming in here and it's asking for the upcoming economic events, I can reword the prompt to answer this question. I can make it
So
go
you
find the
you
data.
you may be in a phase. Remember that video I think I shared with us, where that guy had like 3 or 4 different AIs just spitting out information. You may be at that phase where you need to
Yeah,
start getting somebody comparable, two, 3 other, at least 2 other AI agents. So with this correlation is going to, because one's going to have to fact check the other. You may need to, consider um, getting 2 other AI agents when you're doing this, and do it, like you did before, all at one time. It's more work, or you can always get us to do it, and then share notes. But
yeah,
I think that's where it's, because Gemini is good, but we may be missing out on other angles.
yeah. So here's what I do. To update the to update this model, we want to put in the upcoming labor, which is the unemployment. Well, no, let me go get the employee. Well, I can get the employee here. Well, yeah, I can't click off of it because I can get the employee down here, but once I do that, well, no, I can't do it. I can't do it. I can come back. There's nothing in my prompt. So I could just copy. This is our prompt for the employee. So I can bring it back in here to find the upcoming labor um reports. Use. Hold on a second. Let me build it. All right, so let's do this. I can put this part at the beginning. So I gave it its role. And then now to find the upcoming labor reports, use the following. See how that works? So we're going to give it the employee to find the metrics on its own. And at the bottom of this, I can put minimum threshold quotes. Does everybody want the 75%? All right, let's see what we got. Now let me tell you something else that I'm working on, guys. Because we literally, when we go into 2026, I'm gonna give you guys a heads up. We're building something new. And I'm gonna tell you what I think is gonna happen as we're building these AI models. We're gonna stumble into a new trading system. That's what I see happening. I don't know exactly how, but I can see us literally creating a brand new trading system. And let me give you an example of what I mean. We know that we have the prime correlation, right? The dollar and oil. And we know that every other market is going to have some relation with dollar and oil. Like I said, going together, going against. And if that's going to be our new framework where we're doing this inverted version, it doesn't matter what's in the stock market. We're not limited to just the economic reports. Anything that happens in the stock market, we can have the AI go out and find that catalyst, see how that's going to affect the markets, and then find an inverted. Because once again, because we're momentum traders, there are three momentums that we're looking at, right? The economic reports is just one, but we also have quarterly earnings, and we really do not get heavily into quarterly earnings. But if we were just to trade the Magnificent Seven quarterly earnings, we haven't even gotten into that yet. So finding out when the quarterly earnings are with the Mag 7, Mag 8, I don't know how many there are at this point, but if we can figure out when they're scheduling their quarterly earnings and when that announcement comes out, how is it going to affect the index futures? How is it going to affect oil? How is it going to affect dollar? And then based on those announcements, that's going to create that momentum. If the announcement doesn't give us the opportunity, the inverted market will. Does everybody see this? Because if we're not getting the opportunities from the economic metrics, we got to switch over to the other two. Because here's the second one. The second one, which we were doing that all last year, is looking for the releases. So all the tech conferences, the new partnerships, any of these things come out, when it hits the market, a buyout, the Netflix merger, anything like that, is going to drive the markets up. NVIDIA does a new partnership, any of those kind of things, partnerships, releases, all of that. Once again, how is that going to affect the index futures, and what's the invert? You guys see this? It gives us so many other options.
But when we think about the Mag 7 and our metrics, are we considering just, now that we're with this new inversion, are we considering just domestically, or are we considering other indexes in other futures market like we just did when you talk?
I'm on board with you, because that's the reason why I looked that up next. When you saw all the homework I did, I started off with the inversion, but what did I do? I went over to the foreign markets, because we don't want to just even limit it to that, because there are inverted markets. There are inverted foreign markets to the Dow Jones. So I even told you that maybe the U.S. session is bearish that day. Well, we still got to make our daily goal, right? So we want to be able to either trade overnight, this small little trade, 8 or 9 points. You see what I'm saying? And then here's the thing that a lot of people don't know. The future market doesn't close. And you may have to pay a penalty with your broker, but I would rather pay the penalty if I'm going to factor that penalty into my break-even strategy. Does that make sense?
Yeah, because for overnight trading purposes.
Yeah. Different brokers are gonna charge differently. But if your broker is going to charge you to trade after market, then you just factor that into your break-even strategy. You don't go for 8 points, you go for 10 points. You go for 15 points, you go for 20 points to offset your broker fees. So yeah, we definitely want to look at foreign inverted markets as well. And not just inverted to the Dow Jones and the index futures, inverted to the oil and the dollar, because that's global, right? So we're not limiting ourselves. I love the way that you asked the question. No, we're not just limiting ourselves. Now, obviously, that's where we want to start. But once again, contingency plans. If the U.S. markets is being manipulated, it's just completely bearish, and we want to make sure we're making our daily goal, let's switch over to foreign markets. So we're really, and that's why I said when someone originally came up with the idea, I'm like, oh man, you're expanding this. And I'm loving every minute of it. But I think we're going to stumble as we're going into other markets. We're going to stumble into other trading strategies. And I'm going to give you an example. Something that I'm looking to, I'm giving you guys a little heads up of what I'm considering doing. I know, based on my mentor, trading the EIA every Wednesday. This is how he made his money. He traded the EIA every Wednesday, and he made a killing. So I would love for the AI to go out and find the pattern. There's a pattern. I'm not going to tell you what the pattern is. He gave me the secret, but I can't afford to trade the oil. And remember I said that thing's been sitting in my file cabinet and I just don't even look at it because I can't afford it. But now with this inverted model, I can find an oil ETF, which I always told myself. I even told my mentor that. Why aren't you trading oil? Why aren't you practicing oil? Because I can't afford oil. And when I finally said to him, he said, okay, I understand. He said, you got to practice with something. I said, yeah. So I'm practicing with the index futures because it's the safest. And that's the thing that he loved. I said, yeah, I'm practicing with the index futures because it's the safest market. He said, okay, you got me. He said, go ahead and continue doing that. But at some point, I want you to get into oil. No problem. But this is it. I can always trade oil ETFs. So if I can find that same pattern, because here's the other thing about models, they break. Right? So I don't know if his setup is still working. I'm not going to pull it out because it's a promise that I made that I'm not going to share it with people. But we can go out and find our own version of it. So I would love for the AI to go out and look for historical patterns in the EIA, and then give us setups on either the oil or an inverted market. So we're going to stumble into some new. There may be patterns, and let me give you expanding out. There may be patterns in the dollar index. Think about all the different correlations of the dollar. And I'm not talking about Forex, because I told you that every currency index is a basket of several other currencies, which is inside of your course material. If you go to your workbook, all of those correlations are there. All of those baskets are there if you go to that section of currency index. So even there, within those currency indexes, there may be patterns. And then we look at that and then look for the inverted. So we're really expanding out where we can find some other very lucrative opportunities. Still keeping our setup with, the break even and our low risk and all of that. But like I said, I would love to see how this goes as we go into 2026. I came into this with this, this economic report kind of setup, but like I said, with everybody manipulating the U.S. economy, we may have to go into something a little bit more sure that we can say, okay, I know this is going to work. So that's what I see. I think we're going to stumble into it, just the AI within itself, going out and doing different research and different prompts that we can ask. Go out to the dollar market, run some historical back testing to see if you see any patterns at particular intervals. These are the things that I'm thinking. Look at the 10 o'clock, look at the 9:30, the 10 o'clock, the 12, the same kind of train schedule. Do you see any historical patterns where the market spikes at a certain time? You see what I'm saying, guys? Tell me you're getting this. We got a Charlie Brown in the room. Charlie Brown's teacher. I don't know who that is. Who's trying to talk? Yeah, it's Willie. Willie's the Charlie Brown teacher.
It sound like a chipmunk.
I know. Does everybody get what I'm saying though? Is that literally
Yeah,
you know,
we get it, coach. It's just that the strategy is when it's down here, it's up somewhere else, and we need to
yeah.
be able to pinpoint that.
Well,
Go between. Yeah.
well, that's one. What I'm saying is I'm going to a whole nother type of model where we can literally have the AI back test and look for historical patterns, the same patterns that they're looking for in charts. But what we're looking for is every day at like I'll give you an example. I told you that the natural market, the organic market takes over at 10 o'clock. So if I was to tell the AI that, right, I can tell the AI, I can give the AI the setup of 8:30, 9:30, 10 o'clock. I can give the AI that setup. Look at the 8:30, look at the 9:30. Both of those are manipulated by the institutions. And the 10 o'clock is the organic market that takes over. If I tell the AI that, go back and look historically on if the 8:30 and 9:30 spike, what does the 10 o'clock do? Does it also spike? I wanted to go out and try to find those patterns at the intervals. If the 9:30 and 10 o'clocks both spike, is the afternoon at 2 o'clock going to spike? And what I mean about spike, it doesn't matter which way, whether it's going to go bullish or bearish, because we're using an inverted model. I just want to see if this is up, up, down. If that's the historical pattern, then we can look for the up, up. And then when we get to the down, I can find an inverted. Am I making sense? It doesn't
Yeah,
matter what. Yeah, go ahead.
it's like um, higher highs and lower lows, or peak over peak. You're trying to find that pattern in the inverted market.
Yep, I'm looking for any pattern, and it does. Once again, it doesn't matter if it's bullish or bearish, because we can always put in the inverted to
Yeah,
go out and
because
find.
our 10 o'clock here may be what 7 p.m. in Australia at that particular time.
You got
So
it.
if you're able
And,
to if you're able to connect that time to a pattern on the other side of the planet and correlate those time frames, you can see the opportunities within it, within that pattern, that trend, and then the analysis will have more power, because right now we can't really. We can use our prime correlation, but we haven't got down into the past the Mag 7 that would be impacting those markets, if I'm thinking of that correctly, because the Mag 7 impacts our market, but does it impact other market? And are you using that as your bridge to create this?
yeah, so that's what I see. I see this really expanding out and really getting into other US markets, and then like I said, even the foreign markets, and just looking for those unique patterns, because they exist. And there are people out there making money, and there are people out there like my mentor, they stumbled onto this pattern that they can make money consistently. So we can have the AI go out and find those. And I'll even give you something else. Some of these people might be posting this stuff in a Reddit, in some kind of a stock market forum. People may be discussing these things. So when the AI is crawling those spaces, and we're telling out to go out and find these different trading systems, we can go out and find the trading system, back test it, make sure it works. And then we can take that model. Once the AI confirms, yeah, we found a pattern in this. Now we apply our model, our safety model, our protection, power, precision, and proficiency to make it a safe version, to find the inverted version. I'm super excited. So even if you don't fully understand what I'm saying, you're going to see it in the future as we go into 2026. All right, but let me show you this because it did exactly what I wanted. It ran the employee, right? And I don't even care what the employee is. Like I said, I just want the inverted. So it ran the employee, and then it gave the inverted market engine. Love this 75%. So let's see what it gave. Broad market prediction: the rising unemployment and weak non-farm payrolls signal a rapid cooling economy. While this cements the case of the Fed rate cuts, the recession fear factor typically outweighs the liquidity benefits. Now, I will tell you, I'm just running this as a test, but I think the lock model or the rhetorical model will probably give a better analysis because the lock model and the rhetorical model gives the probabilities, which is what this model is looking for. So this is not a complete version. I just kind of put the acronym in. And I think the rhetorical model would be better because the rhetorical model has everything incorporated with the ethos, pathos, and logos. It has the echoes built into it. It has the trends built into it. It has the probabilities built into it. So I think the rhetorical model would probably be the best one to run on this. Does that make sense?
Absolutely.
All right, so 35% bullish probably 35%. So we know there's a weak job data, recession fears, falling bond yields, matrix selection. If bond yields fall, suggestion, utilities, and staples. So there are now I'm going to double check by going to Grok. And this will let me know if I got to add this into it. What are the ETFs based on utilities and staples? So yeah, these are ETFs. I just wanted to double check.
Okay,
So,
now
yeah.
I remember, Coach. Because you're
Go ahead.
starting with, even though you're building this inversion, because I remember you said we was going first before we started talking about this. You was talking
Yeah.
about following the four horsemen. So that would be gold, oil, dollar, and then you said the ETFs. So as you're building this inversion, you're finding that you're trying to find the right blend of acronyms to start the first leg of this build out model, because you pretty much got the framework in your head, but you need to build the model within that framework. So you're trying to find the right acronyms, but you're using, and if I'm repeating this correctly, Coach, you're using the prime correlation, and you're starting with the four horsemen. So that's pretty much, I would say, the the vehicle that's getting us into the 30,000 feet. I'm trying to use something in my head to translate it. And as we're heading, like say we're heading to Japan or we're heading to Australia, that's the vehicle you're using, the four horsemen. And to tie it all together, eventually when you get there, which is maybe another step, is are the Mag 7 that'll help us create the landing to get us deeper into that market sector to where we can look at different things, we can play around, we can notice, oh, this politics is impacting this. If Apple does that there, it'll impact here because we see a trend. We can get, because right now we're still building out the vehicle.
Yeah.
Am I correct?
We need the catalyst. That's basically what we're looking for. And at this point, our catalyst is not just economics. We're expanding out to quarterly earnings and releases and anything else. Anything that's going to impact the markets. Because here's a secret that we know. It's not about the data every single time. It's about the expectation. It's about the sentiment. So if there's any catalyst that's driving sentiment, there's an opportunity to make money.
You're creating an inverted analysis for expectations, foreign.
Yes, that's what the stock market is based on.
Damn. Oh, okay.
The stock market is not based on real numbers, not short term. And I question long term because of the manipulation. Because with the T virus taking over, it didn't matter what the real numbers were. Remember, when we came into this, we had the strongest economy and the strongest bull market. And the T virus came in and changed everything. Fear, greed, and uncertainty for the first 6 months. Even though the real data, we went through a correction, even though the real data showed nothing but positive and bullish information. Doesn't matter what the real data is. So we got to track the sentiment. The same way that I tell you to look for expectation when it comes to economic events, you got to look for expectation when it comes to quarterly earnings. You got to look for expectation when it comes to corporate releases. It's not the real data when you're talking about momentum, because the momentum is emotion. That's the key. We're momentum traders. So we are emotion traders. Does that make sense?
Yeah, that's this is the king version because we're dealing with sentiments and politics and we know what Jensen Huang gonna do. We see weirdo Tesla guy and we know the devils that we know.
Yeah. So here's why I ran this. I ran this because even though they're giving the suggestion on utilities and let me find it. Oh, utilities and staples, right? And these are once again these are ETFs, but I know they have a dozen more. So you don't have to limit yourself to the suggestions that they give. You can start here, but you may want to check these out as well. And maybe you find one that just really fits what you are doing, and then you want to stick with that. Maybe your broker doesn't offer the XLU or the XLP, and you have to transition over to a different one. So I just want to give you this secondary where you can go out and find different versions. These are different versions of the utilities. These are different versions of the staples. Make sense? But I like how it went right into it. So check it out. Inverted momentum alert. November unemployment. Falling bonds, flight to safety. And that's something else. That's something else that when I was saying, look, going and finding different strategies or different trading strategies. I also thought about that as well. Is that you can make a lot of money. And I'm gonna try to walk you through it so I don't confuse anybody. If the markets are bearish or uncertain, what will the institutions do?
They're gonna run to the safe haven.
Safe havens. So if the markets are bearish and they're running to the safe havens, what kind of price action will we get in the safe havens? If they're all going at the same time,
Yeah, you're gonna get increased volume.
there you go. You're going to get a high spike in momentum. If they're all running to the safeties, that means that you can trade dollar, oil, and gold ETFs so you can trade institutional positioning. Does this make sense?
Absolutely.
This is what I meant about finding other strategies. Because once you find the inverted, once you get to this whole realm, it's a game changer. So, like I said, this is what we're going to be working on moving forward. I'm still going to be working with the economic events, but if this continues, and we'll know by next year, because they said that tomorrow is the last day that we're not going to have the economic reports. So we should be back on track. But I don't want this ever to happen to us again. So we're coming out with a contingency plan. We can go into other markets or inverted markets. All right. So, like I said, I think next time we run this, and I'll even give you an example. Remember, there's the hack this week where there's going to be a bunch of labor this week. So tomorrow we should be able to run this again. I'll put in the rhetorical model. We'll run it again, and we'll see how this looks for the rest of this week. We're going to look at labor, and we're going to see how, as labor is giving us bearish announcements, we'll see if we can come up with some inverted versions. Game plan?
I like it because they're highlighting exactly what I've been speculating for a while, which are utilities. So we're going to be bundling anything. Utilities got to be a major part of it.
Yep. And like I said, I would like to test out some of these models. I really like Safe Haven. The Safe Haven trade, I love it. I love that whole concept. Getting into safe havens and beating, because it's early entry. You're getting into the safe havens before the institutions, or at the same time. Because even at the same time, you can, you're in there when the markets are rising. So if you can time that trade, getting into the gold, the dollar, the bonds, and the oil, getting into those ETFs. And then here's the other thing is, and this is what I mean about the level of inversion, because you can find the safe havens, right? You can find those four horsemen, and I'll give you another example. I'll give you a prime example. So when the markets, go back to normal, the institutions vacate the safe havens. So those four horsemen will go down. So once again, you find an inverted ETF. So when they go into the safe havens, you can make money. And when they come out of the safe havens, you can make money. The inversion changes the game. Nothing is off limits. It doesn't matter if the markets are bullish or bearish. Do you understand the power of this? And
So we're still
no, go ahead.
So bearish here is bullish. So we just go to the bullish on the other side. We're not trading dips or the bear at all. Which because it kind of sound like that. I was just confirming. Okay. Thanks.
Yeah. So we have eliminated the risk of shorting the market. We've eliminated the risk of using leverage, because the model even designed it for their not to use leverage ETFs. So we've positioned ourselves to where even when the markets are bearish, we can find a bullish equivalent and still be able to make money. This inversion changes the game, guys.
Isn't there a movie like that? What's that actor's name? Who played in The Wolf of Wall Street? What's that guy's name? There's a detective. DiCaprio. Isn't there a movie where he plays a detective or something with this young recruit called Inversion or something, where they're walking and the whole planet or the whole scene it flips in on itself. The whole I forgot. I'll look it up and put it.
Look it up. I would
It-
love to know. I would love to know.
yeah, it's a movie that's.
Yeah, I forgot the
I'll
name
look.
of that.
Yeah,
Um,
you know what I'm talking about, David.
was it like Inception or like something
There
like
you
that?
go. There you
Right?
go.
Oh
Inception, I
yeah,
believe.
the Inception. Got it. Got it. Got it. Got it. Yeah, yeah, yeah. You're right. You're right. You're right. Got it. Okay. But yeah, literally, that's what I see happening. Is if we can find it, we can find a bullish version of it and game changer. Game changer. But let's go ahead and leave it here. I love this. So for the rest of the week, we're going to be on the labor. We already know it's bearish. So we can go Wednesday, Thursday, and Friday and look for any other labor reports and then find an inverted version. And I'm going to run the rhetorical model tomorrow because we still haven't even touched probability, which is one of the things in here based on the probability. Because that's the thing. I don't want to give it. Notice how I gave it the 75%. I want the model to come up with the probability and come up with the ratios, all of that.
Yeah, and I think the rhetorical actually give you the different probabilities in
Exactly.
each specific safe haven,
Yeah.
which is more probable at that.
And then the way that I'm going to build it, and I'm going to do that today, I'm going to rebuild our rhetorical model. I'm going to put the acronym in the ethos. I'm going to put a portion. I'm going to put that trading portion of the lock. I'm going to copy that out, put that in the pathos. No, I'm sorry. Hold on. I'm going to put the acronym in the ethos. I'm going to put the echo in the pathos. I'm going to take that. Well, I think I already have that portion, but I'm going to take that break even strategy out of our lock, and I'm going to put that into the logos, and then I could just run the rhetorical model.
Yeah, you might as well because we have the echoes, in the sentiment part of it. So, I think it's just more robust.
Yeah, we can run that rhetorical model, and it'll give us everything that we need because we know we can do it because that's what we did here. So when it asks us for the labor metrics, we can literally say run the rhetorical. So it'll run it, and then it'll do exactly what it did with this one and go right into the inversion, the inverted engine.